Good evening. Peter Klein, Chief Investment Officer, co-founder, ALINE Wealth, with you this evening on the 25th of April, 2023, to provide a little bit of a briefing, our monthly assessment of the conditions in the marketplace as well as the economy. Allow me to share my screen and we'll go through a few of the slides that I've handpicked for our discussion this evening in hopes to give you some context of what we're seeing out there and how we're using this information to navigate the markets and to manage your portfolios. So in this first slide, which is the macro picture, you'll see that we have some, and I said this last month, some real confluence of data points, right? On one end, you have the GDP numbers that suggest that we're just going to skirt by and not hit recession. And then you have strong employment and consumer spending is sort of holding up to some degree. But then the other end, you have things like this, where you have container traffic fell 30% in the last 12 months, where we have commercial real estate having all this debt coming due in 2023, and they're in a world of pain. Loan loss provisions at banks. One large lender reported just last week that they've increased their loan loss provision from $500 million a year ago to $1.3 billion this year. And a major consumer lender increased theirs from $33 million to $1.1 billion. So these guys are on the front lines, and they're seeing stuff that concerns them. And of course, you have the inverted yield curve. These are concerning, no doubt about it, and we're worried a little bit about this stuff, maybe more than a little, given our high cash position. The bigger thing that we're focused on is the debt ceiling issue. And you know that we've spoken time and time again on these videos and the writings that we've done, our blog and etc., about the debt ceiling and the debt levels, right? And how, remember our debt clock video a year ago. It's a serious issue, and it's really odd because it's akin to spending on a credit card and then refusing to pay the statement refusing to pay the bill. I mean, that's ridiculous. They've agreed to the elected officials agreed to make this spending, and they appropriated the dollars, they spent the money, and then they go through this silliness of brinkmanship in order to pay for it. And it's very odd. They've done it 78 times, the debt ceiling raise, since 1960, 2/3 of the time under a GOP administration. So, I mean, it's going to get done. But I worry about the back and forth until it gets done, because this time the political landscape is a bit different than it has been in the past. So I am a bit concerned about that. Next up is interest expense. You'll see here how the interest expense has gone up pretty substantially, and that makes sense with the Fed raising interest rates. So that is too a concern, because we have so much debt in the system that if you have higher interest rates to pay for that debt or service that debt, that's going to crimp margins substantially. Now, on this slide, we turn to mathematics, right? Here's what we're trying to say. When you do analysis, the bottom line is math is unemotional, right? So you're able to use mathematics, quantitative analysis, to point you in a direction without having this sort of, I think this is going to happen, or reading the tea leaves. This is essentially looking at numbers. And what they're doing here is looking at a CPI tranche of 4 to 6%. And at that level where we are, it's typically a 15 times multiple. And then it's a whole series in this red dotted box of S&P, depending upon the estimates of earnings. As you can see, all those are substantially lower than the current 4,100 we are today. So unless the system is somewhat broken and we're not mindful of multiples, we're now trading at 18 times, so I guess that would be likely. This gives someone a pause about being overly allocated to risk. And indeed, if you look at valuations, we do on this slide, in every they're yellow or red across the board from enterprise value to sales. Schiller will see in a moment. Price to sales, all in the red category relative to history. So that's concerning, to say the least. This is relative to the MSCI World, and you can see it's a two standard deviation event, where it's two standard deviations above the mean. That's a level where you're getting a little bit too robust. You see that here, you see that here, right? Right. So we need to be mindful of where we are valuation wise, especially given the previous chart that shows you, given where we are in the CPI, the multiples should not be as high as they are today. The CAPE index shown here is the Robert Schiller Nobel laureate work, and here's a cyclically adjusted price to earnings index. It's come in. That's good news. Still far from the median, which is worse. Let me talk about this concentration that we're seeing in the market 2023, right? If you took the start of 2023 until 4/15/23, the S&P 500 has gone up approximately, well, from 32 trillion to 34.4, right? So what's that, 2.1? No, 2.3. And look at this. Out of that $2.3 trillion of increase in market cap, much of which is in 10 stocks. I mean, that's just unbelievable, but that's what it is. So that is showing you the concentration that we've had in 2023, and that does not give me comfort. We don't want we want a broad rally, not a concentrated rally. When we're looking at innovation, and we're all about looking for innovation. And this is a chart that shows you the adoption pace, the pace of adoption. Look at GPT, 5 days, unbelievable. We're all for innovation, guys. We're just not willing to pay up for it. We want to be able to find the players, the investments, the companies that are involved in innovative activity, but are not maybe front lines. Maybe they're the picks and the axes, as they say, or the back end. And those are the ones that perhaps can not have such a robust multiple, and make it, but they will benefit from it, right? Benefit from this innovation. So, lest you think we are not interested in innovation, that's not the case. We just don't want to pay up for it. Now, what we do want to look at is value investing. This is a lovely chart that looks at the price performance, the performance of low PE stocks. That's a proxy for value, right? Low PE stocks in 5-year periods. So you want to have a 5-year cycle. And if you look over here at the performance of these value cohort, right? I mean, these numbers are extraordinary because first it's 5 years. So, again, anything can happen in 1 or 2 years. 5 years is a nice period of time, and you're buying them cheap. You're buying big companies, S&P 500, and you're buying them cheap, and because they're lower multiples, and that seemingly has always worked and will always work because price matters. That's the number one thing. They've done research over the years, financial academics, and they look at what's the number one factor for investment success, in equity markets. And I guess you could suggest this for credit markets as well. And it's not, who's in which party's in power, or what's interest rates, or what the growth rate is. It's what you pay for the investment when you buy it. If you're buying something at richly priced, you're going to have a difficult glide path. If, however, if you're buying something on the cheaper side, your glide path is oftentimes more robust. So again, what price does matter. On this slide, we're talking about a theme that's been what we've been thinking about for a while, and this is the energy transition theme. And you could see how much money is going to be spent. These are trillions of dollars, 3.2 a year, 4.2 a year, $120 trillion over the next, 30 years. I'm sorry, 30 years. That's a lot of cake, right? It's a lot of money being spent. And we need to do it. Don't get me wrong, infrastructure is a big deal, and I'm all for it. But um, and so we want to make sure. I think it's going to be inflationary because we don't have the copper and the aluminum and the green metals we need to make this happen. That's number one. But number two is, hey, let's get involved. Let's buy the picks and the axe companies. The companies that are doing the heavy lifting in this capex build out. And I think that's going to provide us with big opportunity as well. In this slide, I've been talking about this old regime, new regime, right? This is the old regime. It's the sort of the 40 years from 1980 to 2020. And it looks at, the greatest bond market, bull market ever. And you can see here how, in the 80s, the bonds just went straight up because interest rates went down. Same thing in the 90s, same thing in the 2000s, and even in the 10s, not so much in the 20s. And I think that tells us we're in a bit of a different animal right now. And I think we're in a new regime where persistently stubborn, let's call it stubborn or sticky inflation, is here to stay for a while longer. In this slide, I want to talk about the importance of active management. In the old regime, when the price of money was going lower and lower, right, for 40 years, any problems out there, here comes the Fed, we're going to flood the markets with money. We're going to lubricate, we're going to get things through. Lots of good things happen over 40 years when you have the Fed at your back and you have disinflation and lower interest rates. I think that game is over, and I believe we're in a new regime where we're going to have more stubborn or sticky inflation, and that's going to demand a more active management profile. Right? No longer can we simply just buy the index, all the money's rushing into the index, and it's becoming a self-fulfilling prophecy for those handful of companies that happen to be at the top weighted in that index. Now it's back to good old financial analysis. Now we've got to look for the companies beyond the index, having high active share, looking for those positions that are that you do the analysis on that perhaps are not part of an index or are a very small part of the index, but they are opportunistic for your portfolios. So active management, in our view, is back big time. Now, dividends are also back. Look at this slide, and it shows you how back in the 40s, 50s, 70s, how much of the dividends accounted for the total return, right? And historic average is 38%. I think we're going back there. And so dividends are going to become more important, but you have to make sure that you just don't reach for yield, that you look for dividend growers, companies that are growing their dividends consistently. That's the magic. That's where you want to be. Can't do a talk without talking about infrastructure, especially water infrastructure. Love this slide. We're talking about the average annual global infrastructure spend by decade. Look at that water number. Electricity, roads, across the board, all of them. And then here we have 8% CAGR increase in CapEx. Wouldn't you want to buy those companies that are doing the CapEx? Think about the wind at their back, right? We're definitely going to improve infrastructure. It's a critical need. We have to do it, especially for water. So this is an area that we're going to see explosive continued growth. And why not buy these great companies that are behind the radar, underneath the radar, that are providing the infrastructure products and expertise in engineering. Also look at international. This is a graph that shows you how cheap international is versus US. When you look at the price to earnings ratios, on average, ex-US is 11, US is 19. Price to book 1.6, US is 3.9. US is 13, price to cash flow in the ex-US is 7.8. I mean, it's almost half. So there are opportunities internationally. You've got to be selective. You've got to do your homework. You got to pick your spots. But there are opportunities there to buy world-class companies at discounted prices. And this is a graph that shows you many of these companies are multinational. And it is a global phenomenon. Around the world, we're seeing many major companies. And so it doesn't have to be just US. It's been a US growth market for the last 15 years. It's a great financial crisis. I think it's time for the international markets to pick up a bit. And to that end, we're allocating more capital slowly and carefully. Remember, there's a war going on. We're cognizant of that. But we're off finding some really cheap opportunities internationally, developed markets, and to a lesser extent, emerging markets. Okay, this is how you can reach us, of course. Anytime, please do. We're happy to hear from you. I thank you for your attention, and I look forward to answering any of your questions. Feel free to email us. Thanks very much. Have a great night.